Is the stock market really on the verge of a crash? The stock market is doomed, and I'm selling everything. This is the kind of comment flooding social media right now, and I understand why people are concerned. With everything from stocks to crypto taking a sudden dive, it's natural for those of you who have recently started investing to feel anxious. That's why I'm addressing your concerns today, explaining the causes behind the current market turmoil, and sharing my thoughts on how to navigate this challenging situation. Given the urgency of the situation, I'm prioritizing getting this video out quickly, so the editing might not be as polished as usual. What's more important is for you to get the information you need to make informed decisions. This is a video you definitely shouldn't skip. So why is the stock market plummeting? To put things in perspective, the S&P 500 dropped by 3%, marking the biggest one-day decline in nearly 2 years. The Dow fell by 2.6%, and the Nasdaq slipped by 3.4%. This is certainly alarming. Based on my research, there are 4 main reasons for this downturn, and we'll examine each one to determine whether we're facing another historic market crash akin to the 2008 financial crisis or just a minor bump along the road. Reason 1: recession fears. The first major concern is recession fears. Historically, when the economy slips into recession, the stock market tends to follow suit. Recessions typically mean reduced consumer spending, which leads to lower corporate earnings and job cuts. This, in turn, further depresses spending and profits, creating a vicious cycle that drags down stock prices. But here's the twist: we're not in a recession just yet. The stock market often acts as a leading indicator, reacting to early signs of economic trouble. Recent reports showed the U.S. added only 114,000 jobs in July, below the expected 150,000, and unemployment ticked up to 4.3%, its highest since October 2021. This uptick in unemployment has triggered what's known as the SAM rule, which has historically predicted recessions with remarkable accuracy. The rule states that if the average unemployment rate over 3 months increases by 0.5% or more from its lowest point in the past year, a recession is likely. Goldman Sachs has increased its recession probability forecast from 15% to 25% based on this data. However, the SAM rule isn't infallible. Claudia Sam, who created the rule, herself suggests it might not be as reliable this time around. Unemployment is rising not due to job losses, but because more people are entering the job market. Additionally, past recession signals like the bond yield curve have proven unreliable recently. Reason 2: interest rates. The second factor is interest rates. When the Federal Reserve hints at cutting interest rates, it can signal a looming recession. A quick look at historical data shows that past Fed rate cuts were often followed by recessions. Recently, the Fed hinted at rate cuts, which initially sounds worrisome. But here's the nuance: the Fed raised interest rates sharply in 2022 to combat high inflation, a side effect of the pandemic's economic upheaval. Inflation peaked at 9.1% and has since dropped, but remains above the Fed's target of 2%. The Fed's potential rate cuts now are a sign they're getting close to achieving their inflation target, which could actually be positive for the economy by stimulating growth. Lower rates mean cheaper borrowing costs and more money circulating in the economy, which is a good thing for investors. Reason 3: tech stocks. Now, let's talk tech stocks. If you've invested in major tech companies often referred to as the Magnificent Seven, including Apple, Amazon, Alphabet, Meta, Microsoft, Tesla, and NVIDIA, you might have felt the sting more acutely. These giants make up about 31% of the S&P 500, so when tech stocks suffer, it impacts the broader market. The recent tech stock downturn is partly due to an overhyped AI bubble. Investors became overly enthusiastic about AI, pushing stock prices to unsustainable levels. For instance, Warren Buffett's Berkshire Hathaway recently slashed its stake in Apple by nearly 50%. Additionally, some high-profile AI developments, like Apple Intelligence and NVIDIA's Blackwell chips, have failed to meet expectations, causing further declines in stock prices. Reason 4: Japanese yen. Finally, let's look at the Japanese yen. Traders had been borrowing money in yen at very low interest rates and investing it elsewhere. When the Bank of Japan raised interest rates, the yen appreciated, causing traders to sell off assets to cover losses. This dynamic has contributed to market volatility, although recent easing by the Bank of Japan has calmed some of these concerns. Navigating the market turbulence. So, with all these factors in play, how should you approach your investments? 1. Buy when there's blood in the water. The classic advice to buy when there's blood in the water means taking advantage of lower prices during market dips. Ensure you have an emergency fund of 3 to 5 months of living expenses so you're not forced to sell investments at a loss. 2. Dollar cost averaging. This strategy involves investing a fixed amount regularly, regardless of market conditions. It helps smooth out the effects of market volatility and reduces the risk of making poor investment decisions based on short-term market movements. 3. Diversify your portfolio. Spread your investments across different asset classes, stocks, bonds, crypto, etc. Reduce risk. If you're heavily invested in tech, consider broadening your portfolio to include other sectors or funds. 4. Think long-term. The market will bounce back from downturns, as it always has. During downturns, resist the urge to sell and panic. Remember, selling during a dip locks in your losses. Instead, stay invested and focus on long-term growth. In summary, while the market is currently experiencing a rough patch, history shows that these downturns are often followed by recoveries. The S&P 500 is still up more than 9% since January, and corrections are a normal part of the market cycle. As we navigate this turbulence, staying informed and making strategic decisions based on long-term goals will serve you best. If you're eager to dive deeper into investing strategies or want to see how I pick my stocks, be sure to check out my next video. And don't forget to subscribe for more insights to help you grow your wealth. See you over there.